Hello and welcome to another assignment in which we're going to work on our homework problem from chapter 10. And this problem we have Major League Apparel that has two classes of stocks that they're authorized to issue. 6% $10 preferred par value preferred stock and $1 par value common stock. The following transactions affect stockholders' equity during 2021, its first year in operations. So just to kind of give you an idea as to what we're working on, they've asked us to record these transactions and then prepare the stockholders' equity section of the balance sheet as of December 31st, 2021. They've also told us net income for the year is $490,000. We'll use this at the very end. So what I have over here is my journal entries, my general journal setup where I'll do my journal entries. I have these notes over here. And then the stockholders' equity section. That's the part 2 of the problem. So let's get started with the first transaction. On January 2nd, we issued 110,000 shares of common stock for $70 each. Now remember, the common stock has a par value of $1 each. So let's start out with, I issued stock, which means I got cash. So let's start with the first part that's easy. I'm going to debit cash. I got $70 from each of the shareholders, each of the shares that I issued. I issued a total of 110,000. So this number over here, I'm just writing, these are my notes, the number of shares that I've issued. I issued 110,000. The cash I received is 110 multiplied by 70, it's $70 per share. So that's a total of 7,700,000. Now, common stock that I credit, I can credit it only to the extent of the par value, which is $1 per share. So 110 multiplied by 1, that's how much I'm going to credit common stock. Now, obviously, I collected more than the 110. I collected 7,590,000 extra. So $70 per share, which means $69 extra is what I've collected. So that has to be credited to a different account. And that's called additional paid in capital. Paid in capital, it's paid in by the investors. The investors gave a total of 7.7 million. 110,000 was credited to common stock. The remainder is credited to additional paid in capital. This is also an equity account, but we keep this as a separate account. We keep these dollars over here separately. Let's take a look at the second transaction in the year. On Feb 14, we issued 60,000 shares of preferred stock for $12 each. Now recall the preferred shares had a par value of $10 each. So we go through the same exercise over here. First, I'll start out with cash debit. Now here I'm going to write down, this is just two columns I have, one for common and the other for preferred. Here I'm going to identify how many preferred shares I have issued. We get down to the appropriate cell over here. I'm having a little difficulty over here with this, so give me a second. There we go. 60,000 shares were issued of preferred stock. So cash is going to be debited 60,000 times 12 because that's how much I sold the shares for. Once again, I will credit preferred stock $10 par because that's the par value. Cash is debited 720, but preferred stock can be credited only 600,000. 60,000 times 10. Now the extra money I got, the $2 per share extra I got, again goes into additional paid in capital. Just like we did over here for common stock, we do the same thing for preferred stock. It's additional money that these stockholders given. I asked, well, I didn't ask, I asked for more, but I said the minimum is $10 per share and they gave me $12. Here I said it's $1 per share and I actually got $70 per share. Now, on May 8th, the company decided to buy back their own shares. Anytime a company buys back their own shares, they put it in their treasury. Treasury is like, you have a safe deposit box, you're putting it in your treasury. Therefore, we call it treasury shares while we hold it, treasury stock or treasury stay. So we have purchased these and we paid cash to buy it. So we bought the stocks back from the people who we had issued it to, from the stockholders. So whatever was outstanding over there, we bought it back from them and we paid $60 a share. So we paid $60 per share. I have this, we paid $60 per share. So let me change this, it should be $60 per share. We paid $60 per share and we bought this back. Now what happens to the shares outstanding? I had 110,000 outstanding. I bought back 11,000 shares. So that 11,000 is no longer outstanding. So my total is 110 minus 11. That's the number of shares that's outstanding. That's significant when you're paying dividends. We'll get to that later on. On May 31st, we decided that of that 11,000 shares that we bought back, we're going to sell 5,500. Now we're going to sell these for $65 per share. That's the market price of the shares. We bought it at 60. We're going to sell it at 65. So let's see what happens over here. Once again, I have cash debit, and the cash debit is going to be 5,500 shares times $65 per share. That's how much I am getting for it. Now I'm going to credit treasury stock, not common stock. I would have credited common stock if they were new shares that I'm issuing. I'm just selling these shares that I had already issued. This treasury stock was shares that I bought back. They were already issued. I was holding them. So I credit treasury stock. It's going to be the same amount. I'm sorry, it's going to be at 60 because I bought it at 60. I credited at 60. Now, the extra money I got, again, is paid in capital. So this is pretty cool over here when you see what's happening. I sold the shares initially for $70 a piece. I bought them back at 60, and then again, I sold them at 65. So I'm making money over here in the process of this buying and selling of my own shares. Okay, this is additional paid in capital. Now what happens to the number of shares outstanding? That's going to go up again. Okay, it's going to go up because I sold 5,500. I'm looking at outstanding means how many are held by the public. Okay, so at this point of time, I'm going to do a total. I have a total of 104,500 common shares outstanding. The original 110,000 minus 11,000 what I bought back, plus 5,500 what I sold again. This is how much the public are holding. And this number is very important for the next journal entry. Preferred shares, I bought 60 and that's all that's happened. So that number just stays where it is at 60. Now let's see on December 1st what we're doing. We declare a cash dividend on our common stock, $25 per share. And we are paying dividends on our preferred stock. They've told you it's 36,000. I'll show you how they come up with that calculation. And they've also given us a hint over here. I'll get back to that in a second. So to start with, we were given this number, common stock, the dividend is 25 cents per share. For preferred share, read this opening sentence over here. We have 6% $10 par value preferred stock. So what we're saying is the par value is $10 of the preferred stock. On that, I'm guaranteeing them a 6% dividend. 6% of $10, if you do that calculation over here, that's 60 cents per share. Now, let's start with the preferred ones. That's easy. I had 60,000 shares outstanding. I'll give each of them 60 cents. So 60,000 times 60 cents, when you do that multiplication, you get the 36,000. Now, in this case, they told us it was 36,000. That number was given to us. But even if it was not given to us, you could have calculated it. I just showed you how to do that. Now, the next one is a common stock. They gave us 25 cents per share. That number is given to us. What they have not given is on what number of shares I'm going to give out pay the dividends. They have given us a hint. Dividends are not paid on treasury stock, which is why I did this calculation. So I have 104,500 shares outstanding. On those shares, each of them will get 25 cents. So when I do that multiplication, the amount I'm paying out in dividends is 26,125. Now, these two numbers we can add them together to see what the total dividends payable is. Okay. Dividends are always paid out of retained earnings. Dividends are always paid out of retained earnings. So here I'm going to do retained earnings debit and dividends payable credit. And the number over here is 62,125, which is basically 26,125 plus 36,000. That's how I get the dividends payable, how much I have to pay. On December 30th, I paid the dividends that I had declared on December 1st. So my journal entry, I'll take off the liability from my books, dividends payable debit, and I credit cash because I'm paying that cash. Again, that amount is already known. I know what I have to pay. It's 62,125. So we have gone through the process of issuing stocks above par value, or common stock and preferred stock. We bought back our shares and then we sold them again. Again, when we sold them, we sold it at more than what we bought it back at. We bought it for 60, we sold it for 65. Dividends are payable only on the shares outstanding. They're never paid on Treasury, because if I pay on Treasury, if I pay on the full 110,000, I'm paying myself dividends, and that doesn't make sense because I'm holding 5,500, I being the company. You will always be told what the dividend rate is, or they will just tell you what the number is. In this case, they told you it's 25 cents per share. For preferred, they told you the amount was 36,000, but once again, you know how to do that calculation now. So now that we're done with this, we can move on to the second part where they want us to prepare the stockholders' equity section. So now this last sentence that we had here, last piece of information, net income for the year is $490,000. So 490,000, this is the first year of operations. Retained earnings basically comprises of net income and dividends. Net income from the current year, you add it to retained earnings. Dividends are subtracted because dividends are paid out of retained earnings. The second year, you will start with retained earnings from the previous year. Now, in this case, retained earnings for the previous year is zero because this is our first year in operation. So beginning balance is zero. Net income is 490. So 0 plus 490 is 490 minus this dividends that you paid out, 62,125. That's why I debited retained earnings. That'll give me the ending retained earnings. So let's see where we're going to put that in over here. So I have Major League Apparel, their balance sheet. I'm obviously doing just a partial balance sheet, only the statement of stockholders' equity. And this is on December 31st, and they have told me the year is 2021. And let's start out and identify what we're going to have in the stockholders' equity section. It depends on whether the company wants to write common stock first or preferred stock first. I'm just writing preferred stock first over here, then common stock, then additional paid-in capital. So preferred stock, I have only one amount over here. That amount comes in over here, which is 600,000. So let me quickly put some arrows over here so you know where these numbers are coming from. Okay, common stock, we have 110,000. That number is brought in over here. Again, let me do a quick insert of an arrow so you can see where these numbers come from. Okay, now paid-in capital. Paid-in capital, I have three numbers. So I'm going to highlight it over here instead of drawing arrows. The paid-in capital, I have three numbers. 3 times I've credited paid-in capital. So you add the three numbers, and that gives you your paid-in capital. So we have 7,590,000, 120,000, and 27,500. That adds up to 7,737,500. All of this is what the stockholders have given me, the company. This is the total paid in. Paid in means paid in by the investors. This is how much they put into the business. Now, what did I do with this money? Well, hopefully I put it to good use, which I did. And I have retained earnings for them. Again, remember, retained earnings is, let me write this down over here on the side so we remember this. Retained earnings is always calculated as beginning balance. You add net income. Well, hopefully it's a net profit. If it's a net loss, you will subtract it, and you will subtract dividends paid out, and that gives you the ending balance. Typically, this is all we are looking at. So in this case, beginning balance is 0. Net income is $490,000. Dividends, we're going to subtract this number that we paid out. This is how much we paid out, leaving us with an ending balance of, just do this so we can see the numbers. So we are left with $427,875. So my retained earnings will be $427,875. And then I have this treasury stock. I still need to put that into play over here. Treasury stock, I have to subtract it. Okay, treasury stock is going to be subtracted. So again, let me highlight this in a different color so we know where these numbers are coming from. Running out of attractive colors, so let's use a less attractive color over here. So treasury stock was debit 660 and credit 330. When you add the two numbers, you're left with a debit of 330. Exactly half has been sold. Treasury stock has a debit balance. Stockholders' equity, everything has an equity, has a credit balance. Therefore, this number has to be subtracted. Okay, so where did I come up with that number? Okay, it's 660 minus 330. That's how much I have in treasury stock. That's okay. Now I finally have my total stockholders' equity, where I'm going to take the total paid in capital. I will add the retained earnings and subtract treasury stock. To come up with a final balance of $8,545,375. Okay, so treasury stock, let me just put it in that same color so you know where that number came from. Once again, your stockholders' equity section has the paid in capital plus retained earnings minus treasury stock. Again, total paid in capital, retained earnings minus treasury stock gives you your total stockholders' equity. Paid in capital is whatever class of stocks you have, preferred stock, common stock, any additional paid in capital. All of that is what the investors put into the business. So that's the total paid in capital. So this kind of gives you an idea as to what happens in the stockholders' equity section. Again, remember that retained earnings, beginning balance, plus net income, minus dividends gives you the ending balance. That number is what you put in the retained earnings in the balance sheet, the ending balance, not the beginning balance. In this case, they didn't give you beginning balance because it's a new company. If it's a company that's been in business, you will always have a retained earnings beginning balance. Unless mentioned otherwise, retained earnings always has a credit balance. So hopefully this helps you work through your homework assignment.